Coming up today, stocks finish lower. Why today is an outlier? Palantir gets slammed. What caused AI stocks to sell off? No crying in the casino. Is the Fed about to disappoint? Are tariffs hurting Home Depot? And is this sell-off in AI stocks and crypto just the beginning of a bigger correction? You don't want to miss this one, guys. Let's go. Wall Street is the greatest show on earth. We just got a massive rotation today. At a mega cap tech, which you can easily see on the heat map. The AI trade coming off hard today. Palantir almost down 10%. The big dog Nvidia uncoiling for the first time in months, down over 3.5%, whilst we saw a lot of buying in consumer defensive, utilities, and healthcare stock. And it was a real outlier of a day because we actually had positive breadth. A bit more than 200 stocks advancing versus declining, whilst the market was down almost 1%. In fact, we've only had 2 days with better breadth and a bigger loss. So it was a very unusual day, technically speaking, even though we didn't get a big headline to drive this. And the market's still sitting pretty in the greed zone. Are we seeing a bit of profit taking ahead of Jay Powell's speech on Friday? Or is seasonality finally kicking in? We can often see volatility rise at this time of year, especially coming off rock bottom lows in actual volatility in the market. Just looking at a composite chart of the S&P, bonds, gold, the euro, oil, and Bitcoin. Combine all that together into realized volatility currently at multi-year lows, meaning all asset classes are hardly moving. And we're most likely towards the end of this volatility contraction cycle than the start. And so stick with me today. We're going to take a look at this issue. I'm going to show you all the most important data, news, and charts. Smash the like and subscribe button, and these daily videos will show up in your feed every day after market close. And so first off, we shouldn't be surprised to see a little profit taking and pullback here. A lot of these AI stocks, retail favorites, and non-profitable tech have actually been the best performing since the market made lows back in April and have squeezed a lot higher. Big part of that is retail traders buying the dip, and hedge funds and institutions, if they weren't short, they were sitting out on the sidelines. Interesting to note, almost 2/3 of institutional fund managers voted for Biden. Did their politics keep them out of this rally? As a lot of them just started playing catch up, but now we've got a massive rotation in the market. Is this the start of a bigger sell-off and correction? Is Jay Powell's language going to accelerate the downside in these hot retail favorite stocks? And are we going to continue to see these old economy type stocks continue to bounce? Here's a list of today's 30 best stocks in the Russell 1000 percentage chain. And a few of these stocks have been beaten down and are starting to wake up today. So it wasn't a huge bearish breadth of a day. In fact, there were still heaps of stocks going up today. It's just some of the hottest ones are getting sold off hard, like I'm about to show you on the chart. Palantir, the AI darling, been on an absolute heater this year, coming off almost 10% today, just after we got news yesterday of famed short seller Andrew Left revealing a short position in the hot stock. And The Economist over the weekend saying Palantir is the most overvalued stock ever. Left's got a $40 target on it, and it may have just gotten the kiss of death from your boy Jim Cramer, who once again nailed the top with a super bullish comment. Stock down almost 30 points since then, but we've also got other things going on. I think this headline may have spooked the AI trade today a bit. Meta planning to downsize its AI division after going on a massive spending spree, for which the Zuck has been highly criticized for how much he's spending on acquiring AI talent. Now it looks like they're going to dismiss some high-level executives and introduce third-party software, as the Zuck is running at full speed to catch up to the popular chatbots, GPT, Gemini, Grok, Claude, Perplexity. And we also got another sign of the times. No doubt there's a bit of froth out there, as once again career grifter Chamath Palihapitiya, also known as the SPAC King, who launched a bunch of blank check stocks back in 2020, 2021, in which they essentially raised capital from investors on the promise to buy a private company and take it public. Sounds great on paper, but the reality is he ended up rinsing millions of retail investors with huge promises. He calls himself the next Warren Buffett. In reality, he's just a very good huckster. Looking at some of his returns from those SPACs, most of them washed away all of investors' capital. Some of them even got completely liquidated. But now he's trying his hand again with the newly named American Exceptionalism Acquisition Corp, raising $250 million, which no doubt's got people saying that it's happening again. The grifter's back out in action, looking to see who wants to buy into his latest pump. But as he'll tell you himself, don't go crying to him if you lose your money back in his latest SPAC. He's just cashing in on what he thinks can be cashed in on. And just to be clear, this is something Warren Buffett would never do. So I strongly disagree with him when he labels himself the next Warren Buffett. But no doubt it is a sign of the times. As we've been saying for a few weeks, retail favorites have gotten a bit frothy here after the bounce from April lows. And we can see that in Goldman Sachs, retail favorites, stock basket today having its biggest fall since those April lows. And an easy way to track a basket of retail favorites is through the Van Eyck Social Sentiment ETF, ticker symbol BUZZ. It too having its largest fall since April, down 3.34% today. And looking underneath the hood of this ETF, it is full of retail favorite: AMD, Palantir, Robinhood, SoFi, Rocket Lab, Nvidia, AST Space Mobile. And there's a look at the chart of Palantir today. Quite a heavy red candle there. Big volume, 136 million shares, down 9.3%, closing a touch below its 50-day VWAP on a downward momentum thrust signal. And when my indicator fires that signal off after hitting a high, it can mean there's a bit of force on the downside, as we did get a little recently stretched there, giving us some reversal signals, and we're still selling off after hours as I speak, going down to a 5-minute chart. The selling is continuing. And no doubt, this is kind of like the canary in the coal mine for that AI trade. Not saying it's topped out, not saying it's the start of a bear market, but there's definitely room for a short or even medium-term pullback consolidation after it's been on a monster run. In addition to the largest stock in the market, Nvidia, having its biggest sell-off. A few months here, still a few points above the 50-day, but other big semis as well, like AMD, look to be testing the support of the 50-day, which you could kind of think of as an automated trend line. Same with the other big AI heavyweight, Oracle, actually took out its 50-day, and more smaller, high beta AI stocks like SoundHound AI. Also coming off a bit, along with other retail favorites like Rocket Lab, finishing heavy, down 9%, also losing its 50. And similar story for Joby Aviation, big bearish engulfing candle there for SoFi. Oklo also losing the 50. Quantum stocks pulling back, quite a bearish candle there for retail favorite Robinhood on a downward momentum thrust signal as well. So definitely the potential start of a bigger pullback and correction in these hot retail stocks, and a further rotation just into all the other old economy stocks. Looking at a spread here of the S&P 500 equal weight, because unlike the normal S&P, which heavily weights mega cap tech, the AI trade, versus BUZZ, the ETF full of retail favorites. Big day today, up almost 4%, closing above the 50-day volume weighted average. Looking like strong signs of a bottom here. So for sure, this could be the start of something. We often see this at the start of a rotation. Big thrust of a move off a low or off a high, big candles, big volume, big rotation, and this can go on for weeks, if not months. So that's something to be mindful of, because it's not just AI stocks, it's also the closely related crypto sector, as many retail traders are big on both AI and crypto, and so they moved in tandem today. Quite a pullback there across the crypto space, with Bitcoin closing below its 50 and testing recent support here, along with crypto-related stocks like Coinbase, looking a little technically weak here, not being able to close that gap from its earnings a few weeks ago. And we actually just got Strategy, the Bitcoin treasury company, firmly closing below its 200-day moving average, its long-term trend. It did briefly do it for one day back in April, but it didn't actually make new lows there, and that was kind of a telltale sign, like Palantir, Nvidia, and a few others that didn't actually make new lows, that they had some strength coming. But the market isn't pulling back, and we've got Strategy here losing its long-term trend, which I think is definitely noteworthy. And other recent new crypto IPO stocks, Circle, looking pretty soft here, along with Bullish, crypto exchange owner of CoinDesk, that just came onto the market last week, getting sold off pretty hard straight away. But I've got this on my watch list, and along with Figma as well, keeping an eye over the next couple of days, week or so, for a potential dip buy and bounce play, using options of course, so I can define my risk and I'm not vulnerable to any gap downs. Because even though these high beta crypto stocks are getting knocked about, definitely looking a little soft technically on the charts. Just looking at the underlying crypto of Ethereum, which is closely tied to a few of these crypto stocks, ETH treasury companies, stable coins, even Coinbase, large exposure to ETH, just looks like a regular pullback to me after we did get a little heated here last week. We can see that in my reversal signals indicator. Click the link below this video if you want to get access to all my indicators. And so again, that's what markets do. They trend, and within those trends, a wave up, wave down, wave up, wave down. And a lot of those ETH related stocks can often overreact on both the upside and the downside, as you can kind of think of them as a highly leveraged play on the crypto itself. And there is this popular chart currently being circulated on social media, which is often misunderstood. In fact, some of the biggest FinTubers on here will mislead you by saying lots of traders and funds are bearish on Ethereum because of this. And that's because, as usual, they have no idea what they're talking about, as they're only good at making videos, not actually trading the markets. And so what this chart shows is a record amount of net short positions in Ethereum futures, traded on the Chicago Mercantile Exchange, CME. And so this is actually caused by what's known as the basis trade, where hedge funds will go long spot ETH, either through an ETF or in the crypto market, and short the ETH futures for a low risk carry trade. These funds are not outright bearish Ethereum. They're market neutral and just clipping yield from the futures premium. And as the futures contract expiry approaches, the futures price converges to the spot price. And so the difference, the premium they sold at, is the profit. For example, you can see here in the spot market, Ethereum's currently trading at 41.40, whereas the Ethereum futures are trading at 41.48. There's $8 of profit in there going long spot, short the futures. That's called the basis trade or carry trade, which again, other FinTubers out there have no idea about. In fact, they can't even tell the difference between futures, spot, and indices. So if you want to follow somebody who's been doing this for 20 plus years, worked at an investment bank, versus somebody who just tries to sound smart but hasn't a clue what he's actually talking about, then subscribe to this channel, click Capital, and you can understand what's really happening in markets. But in addition to short sellers coming for Palantir, and most likely a bit of heat, froth, and profit taking coming out of these retail favorite stocks, AI trade, cryptos, I think the market could also be getting a little nervous of what could be coming this Friday, also causing traders and funds to take a few chips off the table. Many expecting Jay Powell to turn dovish. He may actually hold the hawkish line, cause markets to quickly reprice, or may actually do something in between and signal to the market what's known as a hawkish cut. That is, signal he may be able to cut rates 25 basis points, but that will be just to kind of throw us all a bone and say, here's your cut that you've been demanding. Now I'm going to stay on hold. Still keeping US rate above 4%. And interesting to note, if you strip out shelter of CPI like they do in Europe, inflation in America is actually lower than Europe, and the ECB's got their rates at 2.5%. So there's a big divergence in US rates when you compare data across the world. And there's a look at the latest odds. We're going to get a cut next month, about 85%. We'll be paying attention to this one after Jay Powell speaks on Friday. But just looking at the price action and bond yields today, I don't think we can say this sell-off is caused by inflation fears. Just seen a little bump up in yields over the last couple of days. Nothing crazy, and the market is still well below where the Fed's at. But again, late August going into September can be a period of time when we see a pullback in the market. We did just finish bumper earnings season. Of course, Jay Powell could have an effect on markets on Friday. We did get a little bump up in PPI last week. Hasn't really found its way through to CPI. But just looking at price action, what we've got going on is a big rotation. And there's still a chance we get a late summer small cap rally if the mega cap tech heavy S&P and NASDAQ do pull back because they're at record concentrations. The earnings growth gap between the Russell 2000 and S&P 500 is set to close over the next year. We are likely to get rates at some point, even if Jay manages to stay on hold until his term's set to finish in May next year. And unless we see a full-blown recession, companies are likely to keep on spending big on buying as many GPUs as possible, which should keep the AI trade alive, even if we do pull back for a few months here. And I wouldn't be surprised if Nvidia does reach 10 trillion by 2030 before the secular bull market. An AI boom, which very well could be moving into the bubble stage. Doesn't mean you can't make money, just means it's likely to go a lot further and a lot longer than what most people expect. Interesting article out in Business Insider today, why years-long bear market slumps may be a thing of the past. Not saying I agree with it, but certainly do make an interesting point. According to research by Haverford Trust, the declining number of public firms and the rising number of share buyback, and that is something we've definitely noticed in modern day markets, especially the last 5 years. You look at how quick the bear market was in 2020. Basically lasted a bit over a month. Then we had another one in 2022 that lasted about 10 months. And then technically speaking, you could say we had one earlier this year. S&P came off 20%. And again, that only went on for about a month. In addition to the declining number of stocks on the market, a lot of people will be surprised. The amount of stocks on the market actually peaked out in the mid-late 90s. And we've seen a big trend of consolidation. These big tech companies just gobbling up entire markets for themselves and other companies staying private for longer. In addition to a huge secular trend of corporate buyback, which further adds to a lower supply of shares out there, not to mention just about everyone's retirement account in the developed world. Buying stocks every day, there are strong supply-demand dynamics that are supportive of higher valuation. And I know it's a controversial argument that always attracts me plenty of criticism, but my long-term viewers know that I've argued for several years now that in addition to those supply-demand dynamics, in addition to greater accessibility to the market, low bond yields, innovation and technology, I believe there's a secular uptrend in valuations, like we can see in the Shiller PE ratio, also known as the 10-year PE CAPE ratio. Over time, it's making higher highs and higher lows. And definitely, we're a little stretched here in the short term if you were to draw a line of regression, like the midpoint of the trend. But the fact is, investing in stocks today is a lot safer than it was 100 years ago, and there's better return on equity, in addition to many other things that are supportive of higher valuations. Nothing to say that this secular bull market can't give us a higher CAPE ratio than what we saw in the late 90s, even though most people think that's the roof. We can't possibly go above that because it's just too crazy. And the fact is, companies are just printing cash like they never have before. And that's what really drives the stock market, is corporate earnings. And AI is just accelerating that. Analysts were expecting earnings were to grow at 5% year over year coming into earnings season. Go back to April, are actually expecting us to be in a recession by now. That was the consensus across Wall Street and economists, as many people want this government to fail. They want to see a recession. They want to validate their criticism. Just hasn't happened yet. Nor are we seeing tariffs show up in inflation that has been widely expected across the board. And one company that should be the most vulnerable to tariff-induced inflation, Home Depot, America's largest hardware store, came out with their latest earnings report today, did say tariffs will lead to price increases, but they won't be across the board. And they actually are still seeing growth in US sales, meeting Wall Street expectations on both revenue and earnings. And this is coming from a massive company that gets almost half of all their products that they sell from overseas. They import almost half of their product. Tariffs been in effect now for over 4 months. They should be getting slammed because prices going up, customers pulling back. The fact is the stock is going up and went up again today on their earnings report because that's simply not happening. And that's because at the end of the day, you could think of tariffs as a tax. If prices are going to go up a lot, it's just a transfer of money from consumers to the government, who is then putting it all back in the economy anyway through spending. That's not what causes structural inflation. What causes structural inflation is a huge increase in the supply of currency. The Fed printing $9 trillion. The government back in 2020 spending trillions of dollars more than what they were making in receipts, having to sell way more bonds. That's what causes inflation. Tariffs are just a tax, and a small one at that. So again, whilst we might get some bump ups here and there in some inflation reading, keep in mind the BLS does a poor job at gathering data to begin with. You want to pay attention to things like Trueflation, which track over 10 million prices in the economy. And again, you strip out shelter, which isn't really affected by tariffs. Inflation's running on a one handle, 1.9%. So I don't think we're going to see massive structural inflation from an average 12% tariff on select imports, not energy imports, just mostly discretionary stuff. And I think once we get past all these tariff fears and the Fed cuts rates, we should be back to the good times. We just may see a bit of a soft Q3 here, some profit taking, fears of inflation persisting for a little bit, then we could be setting up for a bumper Q4 and Santa Claus rally, as the AI trade should resume thanks to really strong driving fundamentals. Just an interesting ad showed up in my feed last night, which I thought I'd share with you guys as I found interesting. Still hiring humans, bland.com, and there's a look at their website. Voice AI your customers will love. And so this is just a huge secular trend I can't see changing anytime soon. AI phone agents. And just think about that for a second. If you're a company, say you already hire 100 people, 200 people, 1,000 people, whatever, to answer your customer support or even sales. And then you're able to train an AI bot to maybe replace a quarter of them, half of them, or even all of them. What's that going to do? It's going to allow you to lay off staff while dramatically increasing profits. And this is not just with Bland. Probably the best known company in this space is the retail hot stock that did come off a bit today, SoundHound AI. You're going to see this a lot in fast food drive-thrus. You'll be speaking to an AI bot soon, along with a robot making your burger or an automated pizza oven. They're already out there. And big companies are already starting partnerships with SoundHound AI. This stuff's inevitable. And so again, we could be in for a little period of weakness or consolidation here, in which no doubt a lot of people will say, oh, the AI trade's now over. Stock's down 50% or whatever. But in my mind, you just zoom out, the long-term trends are still intact. These stocks are going to move around a little bit. They're not your grandma's bonds. They're a little more volatile than that. Even in a full-blown bull market, they're going to have massive percentage drawdowns because it could still be early days. The AI revolution and the market for that matter don't care about price to book ratio, especially when you compare it to 20, 30, 50 years ago. It's a completely invalid measure when looking at tech firms that are so much more profitable than capital-intensive businesses like the markets used to be dominated by. Same with price to sales, all this other stuff. Just looking at valuation metrics in a vacuum instead of relatively speaking, and tech companies just being so much more asset light and high margin profitable, which has also given second order effect. The AI boom also causing a boom in electricity demand and nuclear. You're going to see a lot of companies buy small modular reactors and microreactors to place them on site right next to their data center to help feed them the huge amount of power that they demand. And in fact, we just heard that from Google today, coming out with plans to build a 50 megawatt nuclear plant for their Southeast data centers by 2030. That's the most profitable company in the world, investing directly into small modular reactors. And I expect to see a lot more other mega cap tech companies come out with similar headlines over the coming months and years as they look to secure their own power supply. And again, it's just an arms race for who has the most compute power and who has the lowest cost per megawatt will win in the end. In addition to a huge rejigging of the global supply chain of chip, moving more and more away from Taiwan to America, the most important product in the world, semiconductors have to be secured and made on American soil. I expect to see more government support, along with big sovereign entities and investment funds seeing the same thing. And that's what we just heard today from famed Japanese investor Masayoshi of SoftBank, planning to invest in Intel $2 billion to help boost their efforts in domestic chip manufacturing. And so no no doubt Intel's been under pressure for some time, but they are getting capital infusions to help put a floor underneath it and make this a great American semiconductor manufacturer once again. Stock up almost 7% today, which is pretty noteworthy on a very weak tape for AI-related trades. And moving on, just before I get back into the charts, something I've been talking about of late is real estate, which could be a silent bubble. I'm much more bearish on home prices than I am on AI stocks. We are getting some signs of weakness in the real estate market, with an increase in the amount of home prices falling last month in July. Now 39 of the top 50 cities in America price falls back to those peaks in 2022 after the boom from 2020 subsided. And we're also seeing a rise in the amount of days a typical home is on the market before getting sold, bumping up to 43, which we haven't seen in a decade. Something else interesting going on that we haven't seen quite some time is now cheaper to buy a new house than an existing house in America. Average new home, a bit over 400 grand. Average cost of an existing home in America, 435, which also comes at a time when we've got a huge gap between the average monthly mortgage repayment and the cost to rent, similar to what we saw prior to the GFC. And of course, that unraveled global financial markets as the whole finance industry was so levered to mortgages, subprime loans, highly levered banks. That's a lot different this time. The market's learnt a lot from that. Same with regulations. Capital reserves for banks are higher. They can't lever up as much. There's not as many risky loans. So this gap could close without causing another GFC style event. But to my eye, it still looks like a hungry alligator with its jaw wide open, and history would suggest that it will eventually, inevitably close the gap. And here's a look at the top 15 most unaffordable housing markets in the world. And housing affordability is measured from the average household income versus the average household price. Hong Kong is an outlier due to its physical size, basically a massive city crammed into a little island. A lot of people actually living in cages with, of course, extreme wealth. But the other 14 cities, Western countries, plenty in Australia, plenty in California, and of course, Canada ain't all that cheap either. And what you'll notice with a lot of these markets is they've accepted Chinese money. Plenty of wealthy Chinese trust our governments more than their own. They like to diversify, get their money out of the country, and they'll buy mansions. They literally just sit there. Some haven't even visited them. And of course, that's not the whole problem, but it has been part of it for the last 10, 15 years. And so while everybody's talking about AI's in a bubble, it's going to crash, I don't hear many people at all talking about a potential bubble in Western housing markets. And just wrapping it up with a few charts, looking at the spread here of the Vanguard Growth Fund versus the Vanguard Value Fund. Definite pullback here, losing the 50-day and growth shares. High beta, high momentum, retail favorites, AI trade, all coming a little unwound today. So I think the question we all have is, does this continue tomorrow? Could it accelerate on the back of potentially hawkish commentary from Jay Powell? Even if it's not a big deal, it could just cause that unwind to continue, because there is plenty of room for AI stocks to pull back some further. Looking at some ETFs like Chat, hasn't even lost the 50-day yet, and so we very well could come to the bottom of the buy-sell band, even just to consolidate for a few months. Wouldn't be all that unusual and wouldn't surprise me all that much, but just going out to the weekly charts, the long-term trends are intact. We've just been a bit stretched here in some of these stocks, so they are overdue a pullback or consolidation at least, which we can quite often see in Q3. And we've still got some retail earnings as well. We're looking at Target tomorrow, and of course Walmart, which should also give us a tell on the US consumer and tariffs. Plus, of course, Jackson Hole. Because at this stage, even though we've seen an uncoiling in high beta AI-related trades today, the market as a whole still not all that nervous. The VIX 9-day at 14.7 is the options market saying things should be okay. And just looking at my S&P oscillator here, did tag the overbought territory on the 13th of August. So we are getting a little bit of a pullback up the front, and maybe results from Target and Walmart could give us a move going into Jackson Hole. Otherwise, overall, things still remain relatively calm, apart from what's going on in Palantir, which is still selling off after hours as I speak, down 2.3% in post-market trading. No doubt this will be a big one tomorrow. Everyone's looking at, and it'll be interesting to see whether we get some dip buying price action or another big red candle, like we got back in late June, where we got a big red candle and it just stalled out, defended its 50-day and reclaimed its momentum. So we're paying attention to this tomorrow, and of course the big one, Nvidia. Can that still defend its 50-day here? Thanks very much for sticking with Click Capital, and make sure you come back tomorrow, and I'll break down all the price action, data and news headlines for you once again. Cheers.